Okay, hi everyone. This will be the lecture on the ethics chapter. Just a summary here of what we went over in class. So, what are we looking at? As I indicated, I had to give a presentation to practitioners, a refresher on tax ethics. So, hey, we're going to talk about that as well. Now, if you're a tax practitioner, right, you're subject to five potential ethical codes. You got the AICPA Code of Professional Conduct, the AICPA Statement on Standards for Tax Services, the Circ 230, the Internal Revenue Code, and the Common Law, right? And the idea with this is while they're thought of as mutually exclusive, like five different things, you can have one like screw up or one no, right? Like something you do wrong in practice that can touch and concern each of these. So, like one transgression can result in a violation from multiple codes of conduct. So, we're going to unpack them separately, but as we'll see, there's a lot of layover between them, kind of similar provisions between them. So, let's start with the AICPA Code of Professional Conduct. Who does this apply to? Well, anybody who is a member of the AICPA, right? So if your firm, regardless of what service line you work in, makes you be a member of the AICPA, then you're subject to their code of professional conduct. And at a high level here, if we were to break this down, right, it's really in kind of four areas. You're going to have a preface, a part one for people in public accounting, part two for people in industry, and then part three that would be applicable to all other members. And if you fall into multiple buckets, right, maybe you do a little, public and a little bit of private industry, you're a consultant, you would apply whatever provision would be the most restrictive between the different parts. Okay, so a lot of what we're going to be looking at today is it's going to be like I'm Moses coming down from Mount Sinai with the Ten Commandments, thou shalt not do this, thou shalt not do that, right? So some of the things here, right, if we're looking at the preface for the Code of Professional Conduct, you have to exercise professional judgment, you have to honor the public interest, act with integrity, be objective and independent. When they say independent, they mean both factually and in appearance, what a third party would believe, right? So, I don't know, maybe you owned some Apple stock, right? And then they asked you to audit Apple's financial statements. Okay, so you sold your Apple stock, and that would make you like objective and independent. However, if you didn't take steps to let like reasonable third parties know that you sold your stock, it may, in appearance, what a reasonable third party would believe, look like you're not independent. So factually, you could be, but in appearance, you wouldn't be. So you have to be both, right? So in that situation, in addition to selling your stock, you'd also have to make some type of like public pronouncement, or there must be some mechanism to tell third parties that, hey, I don't own that Apple stock anymore. Okay, continuing here, you got to exercise due care, be aware of the code, right? Likewise, if you see all of these little like numbers, that's where these items are found in the code. Don't memorize those, right? It's just more of a reference point than anything else. One thing here, right? We mentioned this. You got to be independent. What can be something that compromise your independence that would make you not independent? Well, if there's unpaid fees, right? Specifically, if you have unpaid fees from an attest client for services provided more than 1 year prior to the date of the current year report, you are no longer independent for them, right? So how does this apply to tax practitioners? Um, hey, your firm does their audit in an attest engagement, and you do their tax return. If there are unpaid fees from that attest engagement and sufficient time has passed, you can't really do that tax return now because you're not independent, right? Like it's kind of like your firm's mad at them, right? They owe us money. How can we be objective? How can we be independent when we're mad at them? So in those situations where you lack independence, you need to consider withdrawing from the engagement. Okay. Continuing here, right, you got to act objectively and with integrity, right? You can't be biased. Likewise, and we're going to see this throughout, you can't, as a general rule, charge a contingent fee, right? So a contingent fee is one where the fee amount depends on a finding or result. And generally, if it's a original or amended return, right? So somebody comes in and they're like, hey, can we um, please prepare their tax return? Or can we amend a prior year return? In those situations, you cannot charge a contingent fee. It's usually what you would charge is like a flat fee, right? $500, $1,000. A contingent fee would be something like, if you don't get audited when we do your return, you got to pay us more money. If, or to the extent we get you a refund, we get a percentage of that, right? It's like an if-then type statement, whereas a flat fee is more like it's going to be this amount, right? So as a general rule, you can't charge contingent fees. The exception, and we're going to see this, is if somebody comes into your CPA firm and they says, hey, my return got audited, right? Or I'm being charged interest and penalties by the IRS. Can you please save me, right? In these situations where they're basically in trouble and you have to come in and help them, then and only then can you charge a contingent fee. So, hey, you have interest and penalties, right? For every dollar we save you in those interest and penalties they're charging you, the fee is going to be 70% of that, okay? Next thing here, you have to keep client information confidential, right? You can't be blabbing about your clients outside of the office. There are exceptions for this, right? The most notable is going to be like a subpoena or a summons. The next thing here, form of organization and name of the firm, right? So if you have somebody in the title of your firm, it's like Jones and Smith, right? And there was never a Jones associated with the firm. Who is this person? Well, in that case, that would be a misleading name. Likewise, right, you have to have reasonable and fair advertising. That is to say, it can't be misleading or deceptive, right? So you can look at this video here with this Ronnie Deutsch, for a situation where they got in trouble, and look at the outcome of what ultimately happened. All right, some other standards from the code, right? You have to have competence. You got to exercise due professional care. You got to plan and supervise. So for you guys, right, for like a lot of you are going to be first year staff, you're not necessarily supervising anybody. You're not necessarily worrying about the firm advertising or the fees. This lecture is actually more designed for a few years into practice. But what this means is the people above you are going to have to plan and supervise you. In other words, if you screw up preparing the return and the manager or something doesn't catch it, or they just put their head in the sand, they can't do that, right? They have to have procedures, controls, mechanisms in place that appropriately and that conform with the code of conduct supervise you. So just be aware of that. Next thing here, you can't commit acts discreditable, right? These are like big no-nos, right? They're like basically wrongs that happen on the job or outside of the job, right? So things like on the job, you refuse to return the client records, right? They give you a W-2 in the beginning, you do their return, they don't pay the fee for you. You can't hold those records hostage, right? Generally, the records are the client's at all times. If the client requests it, you have to give it back to them. There is a difference for work papers, right? What I mean by that is, hey, the client comes in, gives us a W-2, a bunch of K-1s. We then make an Excel document, a work paper that outlines the process and the inputs for the tax return. Well, we don't have to necessarily give them that. The work papers, that's firm product, right? Firm work product. But client records are ownership of the client, right? So client records, always the client's. Firm work product, the work papers, as a general rule, are the firms. If there's a dispute over the fee, you don't necessarily have to give them those work papers from the firm. Likewise, right, other acts discreditable, basically lying on the tax return, taking positions that are unreasonable or false or misleading. One thing here, failing to file your own tax return timely, right? You got to file your 1040 by April 15th. hey, you forget to file that, or it's April 16th, you have just committed an act discreditable. Likewise, any kind of like mid to high level crime is going to be an act discreditable. You get a DUI, right? You do this, like even bigger ones, right? So, like I heard a story one time, a CPA, they were going through a divorce. Instead of wanting to get the divorce, they hired a hitman or something to take away or kill their significant other, right? Well, that would be an act discreditable. That's not a good thing, right? That could ultimately have you lose your CPA license. Okay, so if we look at this question here, we have a CPA and they're approached by the client. The client says, hey, can you please return my records? The CPA says, we'd love to give you these records, but hey, you still owe us the fee. What does the AI CPA say you have to do here? Well, essentially, the records are the client's, right? You can't hold those things hostage, right? So refusing to do so would be an act discreditable. All right, next up here, the statement on standards for tax services. We'll see at the end, right? Like, so the code of conduct and the statement on standards on tax services, these aren't law per se, right? It's not like you can go to the federal government or the state government and find these things. Where they come into play is if you get sued for negligence, which we'll talk about. There's like 4 elements to that. They help establish the standard of care. Now, specifically with the statement on standards for tax services, they don't replace, but instead they supplement the Internal Revenue Code and the CERT 230, which we'll look at. But what are they? Right. Well, it's like it says the statement on standards, right? So there's 7 standards. First one here. Tax positions must have a realistic possibility, namely 33% chance of being sustained on challenge. So that would be on an undisclosed position. Or 2, on a disclosed position, a reasonable basis, 20%. So when they say a tax position, that's basically like taking a stance on a tax return. Hey, we're going to take this deduction. Hey, we're going to report this income. It's basically doing something on the tax return. And if you take these actions, you take a tax position, you must have basically a 1 in 3 chance of believing, hey, if we get audited by the IRS, at least 1 in 3, we're going to win this thing, right? And that's on an undisclosed position. So you just file the return normally. If it's a disclosed position, what that means is you file the return, and on top of that, you attach a schedule that basically says, hey, I'm disclosing, I'm flagging, calling out to you, IRS, that we are taking this tax position that we're kind of uncertain on. If you do that, you like specifically disclose it and call it out, then you only need a 20% chance. Right, so this isn't that high of a threshold if you think about it, 33% chance. Right, like if you went and you were getting brain surgery and they said, oh, it's like a 1 in 3 chance, that we believe this is going to work, if we do an operation on your brain. That's like, you wouldn't really feel that confident about that, but that's the standard for tax, okay? The next standard here, right, you got to make reasonable efforts to obtain information from the client. Generally, you're not going to have to examine or verify a client's supporting data. What that means is what the client gives you, unless you have reason to believe or a reasonable third party would believe this is like really messed up, you can take them on their word on stuff, right? So in practice, for example, what did I see? Well, hey, you prepare 1040s. A lot of times the client will just like handwrite a big list of all the charitable donations, right? It's like literally on a piece of paper without the receipts. You can just assume, right, that the client is acting in good faith for that. Now, there are some exceptions if you get like giant charitable donations, but that's a simple example to say, hey, as a general rule, you don't have to go and verify all this stuff. You can just assume what the client gives you is good, true, and accurate information. Likewise, you can use estimates. You can change tax positions if there's a change in law. And The other thing to be aware of here is if you discover an error on a prior filed return, right, you need to tell the client about that, right? So, hey, we did your return. Oh, we forgot to input this document. We got to, let them know. You can't just like pretend like you're not aware of this. Likewise, as a general rule, you're not going to rat your client out to the IRS, right? Really ever, because we have this overriding duty of confidentiality that says, we need to protect our client. Like we can't be, talking to everybody. So generally, right, you find out your client is doing something bad, they're cheating on their return. You don't write into the IRS, you don't call the IRS as their CPA, right? You just tell them, hey, I'm aware this is going on. I would advise you to, do the right thing. And if you fail to do that, I'm going to have to withdraw. Okay. Standard 7 here, right? You got to provide appropriate oral and written advice, right? So anything you put in writing, remember, be careful with that. All right, let's move to the Circ 230. So this is divided into 5 subparts, A through E. We're really going to be looking at A and B here. And A says, right, and what's kind of the point of the Circ 230? Well, this is basically giving rules, policies, and procedures for those who practice before the IRS. But that begs the question, right? What does it mean to practice before the IRS? So you can see and read this big definition. It's basically all encompassing. Anything reasonably related to doing a tax return or tax advice, consulting, all the way up through like an appeal, working through the IRS, that's going to be considered practicing before the IRS. Now, if we talked about what is practice, the next question becomes who can practice before the IRS? Well, essentially, you have attorneys, CPAs. Generally, it's going to be credentialed people. If you're not, right, that's fine. You still do tax returns if you're not credentialed. But you'd have to then be a registered tax return preparer, where it's basically just giving them your information and letting the IRS know that you're preparing tax returns. And in that vein, right, if you are preparing a tax return and it's for compensation, then you must have a PTIN, right? So a PTIN is basically a prepared tax identification number, and it comes down to you put that on the return. That way, if there's some kind of issue or something, right, the IRS sees this and they're like, well, who prepared this return, right? They're really screwing this up. They can link up that PTIN to you. Okay, so you need that if you're preparing returns for compensation. So, hey, you're doing an internship in tax over the spring or in the summer, you need a PTIN, right? When might you not need a PTIN? Well, if you're totally doing it for free, right? So, for example, the VITA program. If you participate in VITA, you volunteer and you're doing like real returns, not for compensation, it's free. Don't need a PTIN. Okay, so this example says all of the following parties must get a PTIN except, right, C here, if you do it for free, right? So if it's totally free, you don't need a PTIN. In A, right, what's the problem here? Well, you're still charging a fee. In B, what's the problem there? Well, you're not really getting cash, but they're giving you services. I'll do your tax return if you fix my car. Well, you're still getting something that's compensation, need a PTIN. And then D is I'll do your tax return if you give me some of your inventory. Well, you're still getting something. You're not getting cash. If you get something, money, services, goods, that's compensation. You need a PTIN. Right, so here's a little flow chart you can look at. Here's the explanation. Let's continue with the Circ 230. So we said, what is practice? Who may practice? Now, what is the scope of practice? So basically, if you're credentialed, you have unlimited representation rights. If you're not credentialed, so you're not a CPA, but you participate in the annual filing season program, you're going to have limited practice rights. Generally, you can only represent clients that you originally prepared their return, right? So what's the difference here? Hey, somebody walks in off the street and says, a firm did my return 2 years ago and now I got audited. I don't like that firm. I want to come to you guys. Can you fix this? Well, if you want to do that, right, you're going to have to be credentialed, because the idea with that is you have unlimited representation rights. If you're not credentialed, you can't do it because you didn't prepare the underlying return. Okay, so the original return that got audited. Finally, here, non-practitioners, right? So just like some random individual, what can they do? Well, it's the US, right? So you can always fight for yourself. If you get audited, right, you can always petition yourself. You can do your tax return yourself, but you can't do anything for anybody else. All right, continuing here, right? So you got to furnish information on request to the IRS. Again, if you come across any issues or errors, you got to tell the client. You got to exercise due diligence, right? So make sure that you're being appropriately informed, and that you're following the rules, and that you know what you're doing. You're educated. Certain credits, right, or certain like items on the tax returns have an enhanced diligence standard. And what that means is there's something above and beyond you got to do, right? So for example, the earned income tax credit, for that guy, there's like a separate checklist you got to fill out. You can't just claim it on the return without doing that enhanced due diligence. All right. Likewise, you can't unreasonably delay things before the IRS. You can't accept assistance from or employ someone disbarred or suspended. You can't represent anyone. If you formerly worked in the government, you got to be careful in that regard, right? I mean, you essentially have to be aware of who did you previously have responsibility over. Likewise, you can't act as a notary public. And then, as we've seen before, general rule, no contingent fees. But again, when are you allowed to have contingent fees? Somebody gets audited, or you're trying to abate interest or penalties. All right, so this guy right here, it says, according to the Circ 230, under which of the following circumstances may a tax preparer charge a contingent fee? Answer is going to be D, right here, assisting a taxpayer for a refund in connection with interest and penalties. Okay, so again, general rule, not allowed. Here's the situations where you can have a contingent fee. All right, some other Circ 230 provisions. You got to return the client records, right? The clients own the records, not the firm. Likewise, you can't have conflicting interests. As a general rule, you can't use any misleading statements. Another big one here, you can't sign a taxpayer's refund check, right? So let's look at an example here to show you what's going on. So a CPA charged a client $150 for preparing the tax return. And hey, guess what? When they prepared that return, the client's going to get a $2,000 refund. All right, so it says the client, right, instead of getting a direct deposit for that refund, they say, hey, IRS, please mail me a check for that and send it to my CPA, right? And it says, which one of the following statements is correct with regard to the penalty for endorsing and cashing a refund check? Well, the answer here is going to be B, right? If that check comes to you, you can't cash it. You can't sign it. That is essentially the client's property. Likewise, you can't hold that refund check hostage, right? So, hey, client, you didn't pay me the $150. Like, no, I got your refund, like waving it in front of you until you pay me. No, you can't do that. Likewise, what you can't do is take that check, sign it, and be like, all right, I'll take my $150 and I'll give you the rest. Then that's how we'll settle it up. No, you're never allowed to sign the client's refund check or deposit it into the firm's account, right? Always got to go to the client. You don't want to commingle those funds, right? So there you go. $500 penalty for that. Likewise, right, we're getting to the end of 230 here, a couple more slides. You got to have high quality representation. You can't sign a return or give advice that lacks a reasonable basis. You got to be competent. You got to have procedures in place that comply with Circular 230. Right, so it's not good enough to just say, hey, there's this ethical standard. We think we're following it. Everybody just try your best. No, you actually have to have policies, procedures, written documents that say this is how we're complying with the CERC 230. Likewise, due diligence. If you ask another practitioner for advice, it's got to be reasonable. And that's the end of the 230 there. So let's move on quickly to the Internal Revenue Code. This is elsewhere in the book. I think it's in chapter 2. This is just saying that one way they can get you, right, if you screw up, and this is law because it's the Internal Revenue Code, we're going to have kind of a list here of things you do wrong. Here's the penalty. And the penalty can be civil or it can be criminal. Right, so you can read through these things. Don't memorize the specific, penalty amount. Just be aware that the IRS does have penalties. They can be civil or criminal. And these things can add up, right? It doesn't seem like that big of a deal. $60 a violation. These are inflation adjusted. So, like next year it might be $65 or something. But the idea with this is like, let's just say, it's $60 because you fail to include the PTIN on the return, okay, or your ID number on there. We'll say this is a systemic issue, right? Like it's like a glitch in the software and it just doesn't ever put the ID number on it. Your firm does thousands of returns. Well, it's $60 a pop, right? And there's like 10,000 returns. That's going to really add up, right? So it doesn't seem like that big of a deal in an isolated case, but when you have that kind of bigger systemic issue, it could add up quick. Okay, so this one just says, which of the following is a grounds for a tax preparer penalty? The answer here is going to be B. Where's the screw up here? It says, at the taxpayer's suggestion, the preparer deducted the expense of the taxpayer's personal domestic help as a business expense on the individual's return. So what happened here? Why did we screw up? Well, essentially we were negligent, right? We took a deduction, a personal use deduction that we shouldn't have been allowed to do. Accordingly, we're going to get hit with a preparer penalty on that, right? So here's some of the penalties, again, just showing you them. Here's the explanation if you want to read that. And then finally, right, we got the common law, right? So the common law is basically judge-made law in the courtroom that's established through precedent, right? So it's basically the judges are looking at the written code and interpreting and applying that in a court of law. What's the big one here, right? It's going to be negligence, right? So with negligence, you're looking at 4 legal elements, namely duty, breach, causation, damages. Talk to any lawyer, they're going to know this, right? So what does duty mean? Duty essentially says we in a civilized society have a duty to act as a reasonable person. And specifically, if you, by virtue of your actions, engaging in a tax compliance or consulting engagement and entering into an agreement with the client, by virtue of doing that, taking those actions, you now have a duty to act as a reasonable accountant or CPA in the same or similar circumstances. Okay? And if you fail to meet that duty, right, you don't act reasonably, you will have breached the duty. And if that breach causes the plaintiff, like the client in that case, damages, hey, now my return's screwed up, you have committed negligence, and you could be liable for that in a civil case. Right, so the idea with that is negligence, duty, breach, causation, damages. Why do we care about the duty, right? How do we even know what a reasonable CPA would act like, right? So this is where we come back to here and we say, oh, we're suing for negligence here. we have a duty. What we look to is the code of conduct, the SSTS, the Circ 230s. This tells us while these guys, aren't like law in themselves, they help us establish the duty or how we should act if we're sued in a negligence case. Okay. And then finally here, right, just be aware if you are sued for negligence or if you have especially an act discreditable, what's the outcome? Right. Well, this is where you have to be aware of the state licensing board, right? So the AICPA is separate from NASBA, who is separate from the State Board of Accountancy, right? So the AICPA, that's basically a professional organization. They set the rules, okay? If you violate those rules, the best they can do is basically not let you be a member anymore. We're kicking you out of the club. However, different from them is the State Board of Accountancy, right? The State Board of Accountancy is the only one who gives you the CPA credential, right? So if you guys were in, I don't know, Pennsylvania, right, and you wanted to practice there, you don't apply to the AICPA, you don't apply to them, you apply to the state board to become a CPA, right? And once you pass the exam, you basically take your little document that says, hey, you passed, you send it into the state board, and they give you the credentials. So the state board is the one who gives the CPA license and who takes it away. And what they look at, similarly, like a negligence case with duty looking at these standards, when they're going to sanction you for screwing up, they look to these standards as well. And then who's NASBA, right? So NASBA is kind of like a sponsoring organization. They work with the AICPA. So if you're doing the CPA exam, you apply through NASBA to take the exam. NASBA gives you your results, which you then take and give to the state board. So again, just be aware there's a difference between AICPA, professional organization, NASBA, which basically just helps administer the CPA exam, and then the State Board of Accountancy, that is the one that actually gives and takes away the credential. All right, so we'll finish up there. Thanks, guys.